historically speaking, when that happens, it sends a shockwave through the geopolitical, financial, economic environment. We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers. Hi, everybody. Patrick Karim with Kevin Wadsworth, Northstar Badcharts.com. I'm talking trades, and we're going to look at the yield curve inversion. Kevin has some great insight into that. And are we about to have a market crash or a catastrophe? Kevin, please help us.
The majority of the time, the 10-year yield minus the 2-year yield is a positive number. You can see the chart here going all the way back to 1980s there. And for the majority of the time, the 10-year yield minus the 2-year yield is a positive number. You can see it's above that red line, above the zero line. Now, when the 10-year yield minus the 2-year yield is a negative number, so that means that the 2-year yield is actually a larger number than the 10-year yield. That does happen from time to time. Then you get what's called a yield curve inversion. It's I suppose you could say it's a little bit unusual, but it does happen. You can see on this chart it happens on numerous occasions, but tends not to last for very long. Now, that yield curve inversion inevitably uninverts, and at some point in the future, the 10-year yield becomes a larger number than the 2-year yield as conditions tend to, I suppose you could say, normalize. Now, historically speaking, when that happens, it sends a shockwave through the geopolitical, financial, economic environment in a number of ways, and it's somewhat unpredictable. I'm not an economist, so I'm not about to start trying to veer off into the world of economics. But what I can say from a technical chart analyst point of view is that we've got problems. We've got big problems coming our way, and I've got absolutely no idea what it's going to be called. I don't know exactly what form it's going to take, whether it's going to be a banking crisis, whether it's going to be some kind of stock market collapse, where the cracks are going to appear. But all I can say is that historically speaking, the evidence is firmly in place. You can see the early 90s recession, the Asian crisis, the dot-com bust, the great financial crisis, the repo liquidity COVID event that occurred more recently. When this chart interacts with that zero line, pretty much as sure as eggs is eggs, something bad comes down the tracks. And it doesn't happen straight away necessarily. It's not the moment that this graph interacts with that red line there. It can take a number of months, a period of time for the cracks to show. It depends on the precise conditions at the time. But some kind of event is coming down the tracks. It'll no doubt be given some kind of name after the event. It's some kind of, it's almost like plausible deniability. You know, the mathematics just doesn't work. The sums don't add up. That chart that I showed you previously, the 10-year yield chart, it just doesn't work. The mathematics isn't adding up. So from a mathematics scientific point of view, I can see that this is going to end badly. And from a technical chart point of view, charts like this are confirming that something is coming down the tracks. And precious metals, gold, silver, tend to shine during these periods of extreme economic uncertainty. For a while, as the ripples move through the markets, whatever's coming our way, it's highly likely that everything heads south and everything gets sold off and the baby gets thrown out with the bathwater, all that kind of thing. But as in previous occasions, it's highly likely that precious metals are going to have their bull run leading to much, much higher values. There are a lot of technical charts that back up this kind of scenario and this type of evidence. It's not just one piece of evidence that we look at to build these roadmaps. There's a risk matrix in the top left-hand corner here, which I've stolen from the world of meteorology, and it assesses the likelihood of an event occurring and the impact if that event does occur. Now, we're clearly talking about high-impact event here. Whatever's coming down the tracks, whether it's in the next couple of months or the next 12 to 18 months, whenever it comes into full view, it's going to be a high-impact event. The likelihood of that event at the moment is low. It's a high impact event, so we're in the right-hand column, but it's a low likelihood at the moment because it's not interacting with that zero line yet. We're not there. We know it's coming our way, but for the time being, the likelihood is low. But the likelihood is set to increase as that graph starts to track towards that red line and crosses that red line. We know that we're starting to get into that danger zone. So the check mark in the impact matrix is going to move upwards through the medium likelihood and into the high likelihood box in the top right hand corner of that matrix, and that's when we have those serious problems right on our doorstep. So it's not a precise science. We can't say with absolute certainty which week of the year it's going to happen, exactly when it's going to occur. But we know that this type of event is once again heading our way. So precious metals will have a role to play in that, Pat.
Yes. Well, that chart, the bottoms in the precious metals and copper and all these commodities, they happen below the red line around that area. When it starts turning up, often that's where important lows are put into the commodity complex. And the lows in the stock markets, it's at the opposite. It's after it runs up through that red line, that event happens, right? Like the GFC event happened 6, 8 months, I think 12 months even after the red line was pierced. But as that goes up and starts turning back down, those are the lows in the US equity. So from a risk to reward, the low risk opportunities for the stock market is after the 10-2 skyrockets and starts deflating. That's historically where the low risk entries are for the stock market. And the low risk entries for the precious metals, gold, silver, they're often found at the bottoms when the 10-2 starts uninverting. I don't know. I wouldn't be too scared of fear events. Like, don't be paralyzed by it. Like if you're in an uptrend, all depending where you are, how stretched you are, right from the moving averages, there's a whole bunch of other technical tools we have, Kevin and I there, that help you, ride that waves. Because some people haven't entered the market for the past 20 years because they're scared and they felt it was overstretched. But goodness, there were trading opportunities all for many, many years. So fear events are there, but you cannot hide under the blankets waiting for it to happen, right? If it happens, it happens. You have sell stops, you have protective mechanisms.
And the other thing to think about as well is during the 1970s and during the period between 2000 and 2012, the stock markets went absolutely nowhere. Having peaked at the start of the precious metals bull runs, the stock markets fell substantially during the 1970s and during the period just immediately post 2000. And yes, they recovered slowly, and then they fell again, and then recovered slowly and fell again. But it took fully 10 to 12 years on both occasions for the stock markets to recover the highs that they'd previously had and to hold above them. And it was during that period, both in the 1970s and in the 2000s, where gold doubled and then doubled again and then doubled again and then doubled again. So you only need to do the maths now with a starting figure of $2,000 to work out where gold might be in let's say 7-8 years time.
So that was it. Thanks for watching us on Talking Trades. For more content, just make sure you like and subscribe to get notified.